Welcome to this explainer. Today, we're going to break down Norway's Government Pension Fund Global, or as it's usually called, the GPFG. Now, when most people hear about this, their immediate thought is that it's just a giant pile of oil money sitting around in a vault somewhere. But honestly, we're going to completely shift that view today. Because as you'll see, Norway has built a highly disciplined national balance sheet machine.
All right, let's dive right in and debunk the biggest myths straight out of the gate. The GPFG is absolutely not some giant hedge fund chasing quick, flashy alpha. It's not trying to be a clever day trader at all. It's actually a strictly rule-based system built on a really brilliant strategic architecture. Its entire purpose is literally to take finite temporary income from oil and gas and transform it into a permanent, globally diversified pool of financial wealth. It's all about converting a temporary resource into incredibly durable financial power.
So, here is the blueprint for today's explainer. We'll start with the national wealth machine, then look at the rules driving the machine, the global 70-30 portfolio, the rebalancing edge, governance and performance data, and finally wrap up with risks and investor lessons. Let's get to it.
Section 1. The national wealth machine. Let's take a look at where all this capital actually comes from in the first place.
Now, you really have to look at the systemic flow of this capital because it's fascinating. Finite oil wealth becomes a government budget surplus, which then flows right into the GPFG. But here is the absolute genius of the whole design. Every single drop of that capital is invested strictly outside of Norway. Why? Well, think about it. If they recycled all those billions back into their own local economy, it would trigger massive inflation and just completely overheat everything. By forcing the money abroad, Norway turns the fund into a claim on global productivity rather than a super risky bet on its own backyard.
Moving right along to Section 2, rules driving the machine. Generating the cash is just step 1. The structural rules are what keep it safe.
Okay, this right here, this is their fiscal superpower, 3%. The Norwegian political system actually commits to spending only the expected real return of the fund over time, which averages out to about 3% a year. The mantra here is so incredibly disciplined. Spend the return, not the capital. By avoiding the temptation to just raid the piggy bank for daily expenses, a trap known as the resource curse that has absolutely ruined other resource-rich nations, this portfolio maintains massive risk-bearing capacity. It simply doesn't have to sweat the small stuff or act like a nervous investor.
Now for Section 3, the global 70-30 portfolio. Let's pop the hood and look inside the engine to see how this thing is actually built. You really have to appreciate the simplicity of this allocation. The core of it is roughly 70% equities, well, 71.3% at the end of 2025 to be exact, and about 30% fixed income, sitting right at 26.5%. And hey, notice those absolutely tiny slices for unlisted real estate and renewable infrastructure? They deliberately keep those illiquid sleeves small just to maintain scalability. They aren't trying to turn this into some complicated illiquidity experiment. The simplicity is literally its greatest strength. And when we say broad market core, we mean really broad. We are talking about holding shares in 7,397 listed companies across 44 different countries, plus over 19,000 bonds. It acts as this highly disciplined owner of the global market portfolio. They are not sitting there relying on heroic, concentrated stock picking to beat the market. The strategic allocation itself is doing all the heavy lifting for them. Section 4, the rebalancing edge. This is where the magic really happens, mechanically speaking. The contrast here is just brilliant. Think about it. While ordinary allocators are often forced to sell when things get tough, whether that's due to sheer emotional panic, pressure from their bosses, or leverage issues, Norway's machine is structurally built to do the exact opposite. When markets tank and equities drop below their target weight, the fund mechanically, automatically, rebalances countercyclically. It buys straight into the weakness. It's basically the institutional equivalent of having perfect emotional discipline.
Section 5, governance and performance data. Let's road test this machine with some real-world numbers and structure.
So, there is a very strict, layered governance structure running the show here. It starts right at the top with Parliament passing the law. Then, the Ministry of Finance issues the mandate. Norges Bank manages it, and finally NBIM executes the daily trades. This transparent separation, it's totally vital. It politically anchors the big, scary macro risk choices at the top, so society as a whole agrees on the risk, but it delegates the complex day-to-day trading to the actual market professionals. It's a fantastic way to preserve public trust. And let's look at how this plays out in real time. In 2025, they saw a massive 15.1% gain, pushing the fund over 21,000 billion kroner. Insane, right? But then, in Q1 2026, there was a robust 1.9% pullback. Now, why are we highlighting a loss here? Simply because it proves the architecture remains completely intact. The system does not panic during multi-billion-dollar drawdowns. It just absorbs the volatility, shrugs it off, and stays the course. Plus, the machine runs incredibly efficiently. In 2025, their base management costs were just 3.3 basis points. That essentially means they are paying about 3 cents for every $100 managed. That is astonishingly cheap. Keeping expenses that low at this kind of massive scale is a wildly compounding competitive advantage. More of the global market return actually stays in the pockets of the Norwegian people instead of being handed over to expensive fund managers.
Finally, Section 6, Risks and Investor Lessons. Look, no machine is totally invincible, so let's check out the warning lights.
The system definitely has some clear structural vulnerabilities. Because it's a 70% equity portfolio, it's carrying really high global beta exposure. That means its fortunes are entirely tied to the broader global market. If the world markets crash, the fund crashes with them. On top of that, because it's cap-weighted, it is heavily concentrated in the US market right now. But honestly, the biggest risk of all is political rule drift. There is always that ever-present danger that future politicians might get greedy and demand to spend more of the money locally.
And you know, a lot of countries look at Norway and try to copy this exact same model. Almost all of them fail. Why? Well, mostly because they lack the necessary fiscal restraint or they have really low institutional trust. But the most common killer? They cave to intense domestic political pressure. They end up using the capital as a slush fund for local pet projects back home, which completely defeats that whole only abroad wealth preservation rule we talked about earlier.
So what does this all mean for you? I want to leave you with this final crucial thought. Look, you might not have the sovereign tax capacity of an entire nation-state, and you definitely don't have billions in offshore oil revenue. But you do have a balance sheet. So how can you apply Norway's boring, highly disciplined rules, things like strict asset allocation, keeping your costs dirt cheap, and automated rebalancing, to protect and compound your own financial future? Think about it. Thanks so much for joining me on this explainer, and I'll see you next time.